Good morning, everyone, and a very warm welcome to the first Keystone Capital Webinar. For those of you who David and I have not had a chance to meet in person as yet, I'm Shamik Mukherjee. I'm one half of Keystone Capital, and later during this webinar, you will hear from my business partner, David McClellan. Thank you for making the time to attend today's webinar. We hope it will prove to be an informative and useful session, and perhaps get you thinking about the future and your own finances. Before we start, may I please request you to keep your microphones and cameras turned off during the presentation so there is minimal background noise and so that the presentation slides take up all the screen space in your devices. We expect the presentation will last around 40 minutes. Following which we will open up the floor to questions from you. I suggest the most efficient way of tackling this is for you to ask your questions and use the chat feature. And I will then put these questions to our guests on your behalf. Depending on the device you're using, you may have to look around to locate the chat function. Usually on a desktop, the chat function can be found on the toolbar at the bottom of your screen. We've also allowed plenty of time for questions, as we very much hope that this will be an interactive session. Should we run out of time, we will make a note of any remaining questions and get back to you with the answers by email. Finally, we wanted to share with you the exciting news that we, Keystone Capital, completed our first year as a firm earlier this week. So David and I would like to say a big thank you to every one of you for your support in reaching what we hope will be the first of many milestones. For today's webinar, we're being joined by two expert guests, Laurence Forrester from Cazenove Capital and Nimesh Shah from Blick Rothenberg. Both are professionals we work with very closely, Laurence being a director at Cazenove Capital, an asset manager who are on our preferred panel of providers, and Nimesh being a tax expert we often consult on complex tax matters. Laurence will start off today's presentation by taking stock of where we are halfway through the year and go on to paint a picture of what he believes lies ahead for the rest of this year and perhaps even in 2021. He'll be covering some of the upcoming geopolitical events that might impact on the course of financial markets. So without further ado, I'm going to hand over now to Laurence.
Well, good morning, everybody. I hope everybody can hear me and that you're all sitting comfortably at home. As Shamik has said, my name is Laurence Forrester. I'm a portfolio director at Cazenove Capital, where I've worked for the last 12.5 years. And I'm joined today by Izzy Mickey, who's worked at Cazenove and Schroders for the last 5 years. And she joined Schroders as a graduate trainee following a degree at Bristol University. So by way of an agenda today, we are just going to take you through a bit of an introduction to Cazenove Capital for those of you who don't know who we are, and then just going to run through what's happened in the first quarter of this year, talk a little bit about prognostications potentially for next year, although I know that that's sticking one's neck out a bit too far at the moment, but also then just to give you a bit of a roundup on how we feel markets will fare over the course of the next 6, 12, 18 months. So just to give you an introduction to Cazenove Capital, we are the wealth management business of Schroders and have been for the last 6 years. Schroders bought Cazenove Capital. We were independent at the time, after having been demerged from Cazenove & Co., which JP Morgan bought in 2010. They bought the first half of Cazenove & Co. in 2005 with an option to buy the second half in 2010. And that was when we became independent. And that was actually a decision that Cazenove Capital made rather than JP Morgan, because after liaising with our clients, it was obvious that they didn't want to become part of a big American conglomerate. Having been part of Schroders for the last 6 years, it's obvious that there are huge amounts of advantages both for us and our clients. It's a FTSE 100 listed company. The market capitalisation is around about £8 billion. but 47% of the company's shares are still owned by the founding family, so still owned by the Schroeder family. And if you factor in what's already still owned by staff, that actually goes up to around about 55%. So only 45% of the company is available in free float. The rest of it is owned by the founding family and also the staff. And I think that that gives us a very long-term view. It also gives us a great degree of stability, and that means that we're able to do the right things by our clients. Prior to being acquired by Schroders, Cazenove was actually really just a UK and pan-European business. But since being acquired by Schroders, of course, that gives us a global footprint, and it means that we're able to benefit from their global analytical and research expertise. And that all, of course, feeds through back into the management of portfolios for our clients. So to look at the first quarter, next slide, please. I mean, to give you some idea of the scale of the sell-off in the first quarter of 2020, it was probably one of the most ferocious in stock market history. I mean, certainly in living memory. And the last first quarter that we saw of this magnitude was back in 1720, and that was the South Sea bubble. So that gives you some idea. It's been 300 years since we saw a first quarter like this one. But equity markets are predictive mechanisms, and the reason that the stock market fell so much throughout the first quarter was because it was trying to quantify the economic and financial repercussions of what was going to happen because of COVID. And of course, it was completely unknown at the time. It is something that I know that this word gets bandied around quite a bit, and I may use it a couple of times in this presentation, but it's genuinely unprecedented. So the market, and we've looked at the S&P here, actually fell peak to trough around about 34%. The FTSE 100 was actually a bit more. It was more around about 38%. So the FTSE 100 actually fell a bit more than the S&P. Now, if you just look to the right-hand side, and you can see the table there of the peak to trough drawdown since 1920, clearly the Great Depression is at the top. Coronavirus actually rates number 7 as it stands. Vietnam War, slightly worse, and Black Monday, slightly less bad. But if you look at the times that those drawdowns took, the Vietnam War, 36% happened over 19 months. And the Black Monday crash, which I think those who can remember it know that it was fairly brutal, that took 3 months. The coronavirus sell-off took a little over 4.5 weeks. So it has been one of the most ferocious and brutal drawdowns in stock market history. Can you just go back? The recovery, however, has also been astonishing. And I think that I will come back to some of the central bank intervention a little bit later in the presentation. But the recovery has also been one of the strongest in living memory. It's been the strongest April in the last 30 years. And I think that some people have had some difficulty sort of fathoming why that has been, particularly when the economy looks like it's worsening day on day. And the reason for that really was because of the central bank intervention. And also, as I said, markets are predictive mechanisms. And what the market is saying is that it's actually not predicting company results and company profitability and company revenue streams to be as bad as the market was predicting back in March and April of this year. So if we have a quick review of the year to 2020 so far, so next slide, please. If we start at the bottom left, so you've got currencies, all of this is in sterling. So we've got to think in sterling, and you can see that sterling has actually fallen by nearly 7%. So this is to the end of May against the dollar, about 6% against the euro, and about 7.5% against the Japanese yen. And all of these are really the global reserve currencies. These are what we consider to be safe haven currencies. And that has had an impact also on equity returns. So if you go up to top left, you can see that global equities down around about 2.5% so far this year. UK equities to the end of May down around about 19. US equities, and again this is sterling, so that you have got to factor in 7% dollar strength plus 2.5, and emerging markets down around about 10. So you can see that there is quite a significant divergence in how global stock market indices have performed so far this year. Also, when you're looking at fixed income returns, you can see quite staggeringly that UK gilts have posted a near 10% return so far this year. and virtually none of that is from income. So nearly all of it has been from capital appreciation because yields are becoming more and more compressed. There's been 9% appreciation in US Treasuries and about 1% in Eurozone debt as well. Down to the bottom right, you can see in terms of commodities, and I think that everyone will be aware of what's happened in oil prices this year. The oil price so far year to date is down nearly 50%, and that is also factoring in a 40% recovery in May so far this year. We started with a high in 2020 of $68 a barrel. We went down to 19 and around about 40 at the moment. So there has been something of a recovery, but from a very, very low base. I think it's also interesting to point out that at March futures, so this is how one trades oil, you don't trade the physical commodity, you actually trade the future. And March futures in oil actually went negative by $20. So producers were paying people to take it off their hands effectively, just because there was such a glut of supply and of course no demand because of what's happening in the global economy. So the gold price, you can see, has been very robust. Gold is a very good hedge against uncertainty. Historically, it's also been a good hedge against rising inflation, which may or may not come in future years. But the other thing is that it pays nothing by way of income, but neither does fixed income securities anymore. So whereas you used to buy US Treasuries and UK gilts and Eurozone bonds for the income stream, for the yield, they don't pay anything. So why not own some gold? And I think that that's what's also sort of manifesting itself in investors' minds as well. So if we look at the equity performance by sector, this shows the three different types of investments in terms of the sectors. So on the left-hand side, you've got cyclical sectors, and those prices tend to be affected by changes in the global economy. So in a period of exuberance in global economy, you would expect prices within those sectors to rise, and conversely, in periods of recession, you would expect those prices to fall. On the right-hand side, you've got defensives, which tend to perform throughout the economic cycle. So whether you're in a period of global economic expansion or contraction, what you would expect from those kind of investments, so things like pharmaceutical companies, things like communication services and utilities, is for them to perform throughout the cycle, because people will consume the goods that they produce throughout any economic cycle. And then in the middle, you have the growth stocks, who tend to trade at higher multiples, higher growth rates compared to the prevailing market. So there you have companies like information technology. Now, quite often, these companies don't pay much by way of a dividend, but they actually reinvest their revenues into what we call CapEx, or capital expenditure, through research and development, to actually try and grow the share price. So those are considered to be the growth sectors of the market. What's pleasing to see about this slide is that in May, everything was positive. I mean, and you know, that wasn't necessarily something that's taken as read, but it's nice to see that we are recovering to some extent. But year to date, you can see that it's a very, very different story. And you can see energy, financials, so this is in the cyclical sector, materials. And interestingly, when you look at the FTSE 100 and its performance against, say, the S&P, it's because the UK index, its constituents are significantly things in energy, financial and material sectors. We also have quite a significant exposure to industrials and real estate, which is why FTSE 100 has fared so poorly against some other global stock market indices. As you can see in the middle, tech has had a very good year so far, up 9% in May, up 12% over the course of the year. And similarly, just to the right in defensive, healthcare and communication services. So those are the sectors that have been actually fairly robust throughout the course of the year so far. Next slide, please. So this is a slide that we called the strong get stronger, and I just wanted to give you some statistics about some of the names here. So basically what we've got is the 7 biggest companies by market capitalization. So Microsoft, Apple, Amazon, Google, Facebook, Johnson & Johnson, and Alibaba. And the top 2, so Microsoft and Apple, we were actually on a morning call this morning with some of the Cazenove analysts, and they were telling us that Microsoft and Apple now represent each 6% of the US S&P 500, so between them 12%. But that 12% is actually more now than the entire market capitalization of the FTSE 100. And just to sort of go back a step, market capitalization is basically the number of shares in issue by the value of those shares. So it's the value or worth of the company. And I think that Microsoft and Apple at the moment are both around about $1.6 trillion, and Amazon not far behind, $1.4 trillion. So they're huge, huge companies. And all 7 of these companies actually represent 1/8 of global stock market capitalization. So they could be a country on their own, these 7 companies. Technology and healthcare make up 40% of the S&P 500. So just sort of giving you some inkling as to the themes that we're talking about today, technology and healthcare. And the top 5 stocks, which are all tech companies, represent nearly 25% now of the S&P 500. So, I mean, in terms of just how incredible these numbers are, I mean, for 5 companies in an index of 500 companies to represent a quarter of them is quite staggering. Now, over the course of the last 3, 4, 5 years, we have, as investment managers, been trying to focus on what we see as secular trends. And clearly, they've both been in tech and in healthcare. So both our funded and segregated strategies have started to buy and have quite significant overweights to these sectors. We purchased Amazon some time ago. It's now at an all-time high. We are also interested in slightly more esoteric names within healthcare. So we've been invested in a company called Stryker, which is in robotics, and it's what we consider to be a technological disruptor within the healthcare sector. So we're not only looking at the big names, but we're also looking at smaller names, things that, as I say, that we think are going to be potentially the future unicorns, both in tech and healthcare. But listening to the call on Wednesday, when we had a direct equity investment call, we are now invested in direct stock portfolios in 6 companies that just have reached an all-time high. So in tech, it's Amazon, Microsoft, and Tencent. In pharmaceuticals and healthcare, it was Eli Lilly, Thermo Fisher, and Unichem, which is a Japanese company which operates in that kind of space. So we feel that we've been exposed to those companies, and that we're quite happy to be exposed there going forward. Now, we've also looked back at decades since the 60s, since the 1960s, and you have in the 60s you had the Nifty 50, which were 50 stocks in the US that people just bought sort of almost indiscriminately because they thought they could only make money. And actually, for about 20 years they did, until Black Monday, and then most of them lost about 50% of what they had invested. Throughout the 70s, it was gold. In 1970, gold was $36 an ounce. By 1980, it was $614 an ounce. So I know that was a period of high inflation, but I still think you would have made quite a lot of money buying it at 36 and being a holder still 10 years later at 614. 1980s was the Nikkei. It reached an all-time high of about 39,000 points on the 29th of December, 1989. It's now 22,000. And it doesn't pay much of a dividend, the Nikkei, so you probably lost about 50% of your money over the course of the last 30 years, which is a bit of a sad indictment for Japanese investments. The 1990s was the NASDAQ. That was the sort of first incarnation of IT or technology, although I do remember people standing outside Dixon's handing out FreeServe DVD-ROMs, and actually the market cap of FreeServe was at one point higher than Dixon's, and FreeServe was just a dial-up connection, and Dixon's actually had about 350 sites throughout the UK, which was always something that I couldn't quite square. Crude oil was the noughties, so the decade high in 2008 was $145 a barrel. I think it's around about 40 today, so it gives you some idea of how the mighty fall. And in 2010, in the 10s, clearly it was technology. And we're wondering what will happen throughout 2020s. Will it be technology that continues to prevail? Will it be healthcare? Will it be infrastructure as central banks continue fiscal intervention? Will it be gold if inflation starts to take off and uncertainty continues? Or will it be that the big 5 tech companies become 50% of the S&P 500 by the end of the decade? We're always keeping our options open, and we're always trying to keep our finger on the pulse. Now, in terms of central bank intervention, and I said I'd come back here a bit earlier on, the reasons that markets have been pricing in a V-shaped recovery, and you know, so we've gone all the way back, all the way down, and then most of the way back up, and we're wavering just a bit at the moment, is really because of the monetary and fiscal response to COVID-19 by global central banks. And here we've got the Fed, the European Central Bank, and the Bank of England, and the policy response has been, you know, quite radical, particularly by the Federal Reserve. The ECB and the Bank of England, I think we were probably the first to act, the ECB just shortly after. But the reason that it took the Federal Reserve a little bit of time to get its ducks in a row is because it had to put through Congress a change in statute which allowed them to actually stand behind credit markets. So historically, they could only really bail out mortgage-backed securities and commercial mortgage-backed security companies like Fannie Mae, Freddie Mac, which was really just almost like the property sector and the housing sector. But this time, what they've done is something, as I say, completely radical in that they can stand behind now corporate debt. And so you've got some very, very hard-hit sectors so far throughout the pandemic. We've got airline companies, cruise companies, automotive companies. And what the Fed has said is that unequivocally, we're here to back you if you need it. And I think that that is going to be the agenda going forward. I think that the agenda amongst the world's central banks is to keep liquidity available, particularly while borrowing costs are virtually zero. You know, I mean, if the UK, US and Eurozone can borrow at zero, then what's to stop them just borrowing to bail out companies to keep the economy afloat? And I think that that is something that we will see going forward. Next slide, please. So valuations. Now this slide basically is trying to show you long-term median valuations of equity markets throughout the world. So on the left-hand side, we have got the world, and then we've got UK, US, Europe, Japan, Asia, ex-Japan, and emerging markets. And what the boxes, which are half magenta or broadly half magenta and half blue, are showing is what looks expensive and what looks relatively cheap. And if you're in the blue, you're relatively expensive, you're above the median, which is where the magenta and blue meet. And if you're beneath in the magenta, it shows that you're relatively cheap in terms of the cost of the market. And just to give you a crash course on PE ratios, basically if a share costs £1 and its earnings are 10p, then the price to earnings ratio of that share is 10 times. Now if the share costs £2 and the earnings were 10p, the price to earnings ratio of that share would be 20 times, because you're paying 20 times more than the earnings to buy the share. And conversely, if the share costs 50p and the earnings were 10, then you'd be paying 5 times earnings. So the price to earnings ratio would be 5. So what we're saying here is that the median, or the upper end and the lower end of the median earnings of these different geographic regions are in the boxes, and the blue rhombuses is where we are in May 2020. You can see that, you know, the global market is at 21 times. The median, where the blue and the magenta meet, is around about 15. The UK is about 18, and again, the rhombus is outside of the box, which means it's expensive. The US, we're at 25 times, quite a bit above the box, which would imply that it's expensive, and so on. It's the same with Europe, it's the same with emerging markets. And Japan and Asia actually look reasonably good value compared to the rest of the world at the moment. However, we do have another slide on this. It's not in this pack, but I have shared it with Shamik and David. There's another way of looking at this, and that's when you divide the price to earnings ratio by what we call the return on equity, which is ROE. And that is basically the profitability of the companies that comprise those individual geographic stock markets. So if you look at it a different way, I divide the price to earnings ratio by the profitability of those geographic regions, it looks very different. Whereupon Japan is actually twice as expensive as the US. And the most expensive market in the world, I'm sorry to say, is the UK. And I will share that with, as I said, I've shared it with Shamik and David, and for anyone who wants to see it, we can send it on to you. So on the following slide, we've got earnings estimates. And I won't spend too much time on this slide. I mean, it always should be taken with a pinch of salt. The magenta line again in the middle basically is the all country world. So this is a composition of all of those geographic regions that make up the global equity market. And you can see that EPS growth is probably going to fall by around about 20% this year and grow by about 27% next year. That's clearly estimates. But EPS revisions are quite interesting on the right-hand side. So at the start of 2020, analysts make expectations for the next 2, 3, 4, 5 years, and they've been reined in by 30% and nearly 18% respectively. There are some highlights. They're difficult to see, I know, but I mean, to pick a couple out and to talk again about the themes perhaps of this presentation are healthcare and technology. Both are positive this year, and both we expect to be positive next year. The lowlights, if one can call them that, energy, down 83.5% this year. You can see it's been followed by a big number, plus 250% nearly next year. But if you go down 83, you need to go up by about 500 or 600 to get back to 100. So you can see by going up 250%, you're still down 50 over the course of the 2 years. And the EPS revisions, I mean, for 2020, down 94. I mean, again, to use the word unprecedented, that is pretty unusual. And then 60% in 2021. So again, that's probably one of the lowlights, but we've already touched upon that, so I won't labour it. Now, in terms of expectations for 2020, I mean, it's there's a lot of moving parts this year. It's sort of keeping us very busy. For those of you who think that we're not busy because we're working from home, I would say probably the exact opposite is true. We've all got long hair and we've all got very, very well-tended gardens, but we're also incredibly busy, you know, looking after client portfolios. And the US presidential election is something that we've got to keep an eye on. On the left-hand side, tariffs, that probably is mainly true of Trump and his merry bunch in the GOP. And then increased regulation and antitrust enforcement, that's probably more applicable to Biden and what he may do. But just to sort of run through the two candidates, I mean, Trump, keep America great, that's his mantra, America first, you know the story. Protectionism, you know, he's even said vaccine protectionism. If America or American company discovers the COVID-19 vaccine, it's Americans that will get it first. I mean, he's probably the only person that's brazen enough to say it, but actually I think it's probably true of every other nation state. You know, if the UK gets it, if we discover the vaccine, we'll probably give it to Brits first, and you know, it'd be the same of the Norwegians or the Swedes or the Dutch or whatever. But I'm sure that will be the case across the board. And he is behind in the polls, Trump. But we do have to ask ourselves, is that just because people won't admit that they'll vote for him? I mean, I think that he was behind in the polls about this time 4 years ago when he was up against Hillary Clinton. And look what happened. I mean, I do think that his response to COVID-19 and Black Lives Matter has been called into question. You know, they have the highest rate of COVID-19 infections in America, and also the highest number of deaths. So I do think that that's something that's weighed on his popularity. But the response to BLM, where he called for the military and Biden called for social change, I do think also that has been something that weighed on his popularity. But again, you know, polls are very, very difficult to read. We only have to know that from the last 10 years in this country to know how bad pollsters can be, to know that it's not unfathomable that he may be the next president, or he may serve another term. The Electoral College does favour the GOP, the Republicans. I mean, Clinton won the popular vote by 3 million votes in 2016, but Trump still is the president. He's favoured by the markets. He's continuing to keep taxes low to 2025, or at least that's his pledge. So I'd say from a market perspective, the market would still prefer to have Trump as president, or at least a Republican. Biden, he's not as radical as Sanders or Warren, but he is going to stand up to healthcare companies. He wants to get prescription prices down. He wants to look at large tech companies in terms of antitrust. He believes that they're monopolistic or oligopolistic. which is a bit of a mouthful, but I mean, the point being is that he just thinks that they're too big, and it might be that he tries to break them up. So it's certainly something to watch, if indeed he does go ahead in the polls. And he's likely to increase federal personal and corporation tax. So again, that will be popular with some people, but not so with others. In terms of other concerns for 2020, the Brexit, Eurozone, how will that play out? We feel it's likely to be more economic for Britain and the UK than political, and it's difficult to see how it will blend with COVID-19, which will be the more significant in terms of the economic impact. It will probably be impossible to tell. But for the Eurozone, we feel it's going to be more political than economic, because you seem to have four factions in Europe. You have France and Germany, clearly the founding members. You've got the northern European countries, the Netherlands, Austria, Norway, who don't necessarily want to contribute too much more. You've got the Eastern Europeans who are sort of trying to disrupt what's going on in the EU, and then you've got the Southern Europeans that probably can't afford to pay much more into the budget anyway. So, I mean, that's clearly something that you have to keep an eye on. Other things, second wave of COVID-19. It's probably likely to be less impactful than the first wave. That's just because output has already shrunk over the course of the first quarter and second quarter of this year. But people have learned and learned how to adapt. People are working from home, people are consuming from home. As of tomorrow, people will be able to go out and eat and drink. For how long, nobody quite knows, but people will be able to go to restaurants and bars and pubs and museums and the cinema. So it might be that starts to stimulate the economy to some degree. And then I also think that China is something that we need to keep an eye on, sort of their impact on what's going on in the South China Seas, their relationship with the US, but also things like the Belt and Road Initiative. I think that those are things that are going to they might flare up over the course of the next year or so. So just to give a summary of what's going on in the global economy. So next slide, please. Yeah. So this is the last 20 years of global economic growth. And as you can see at the top, it says 2020 will be the worst year since the 1930s for the world economy. And it's interesting that we've had a few of these from Schroders since lockdown, and I don't want to be too pessimistic, but they've deteriorated every time they've sent us a new one. So the first one I saw of this was in 2020. It said down 3.5%, 2021 up 7.5%. We had one about a month later that said down 4.5%, plus 6.5%, and now we've got one that says down 5.5%, up 5.5%. So I mean, it's obviously very difficult to forecast because nobody knows what's coming. But it's fair to say that if you look back at 2009, which everyone thought was a really tricky period to navigate, financial markets, and then move forward to the forecast for this year, you can see that it's going to be a really tricky year this year. Although we do think that there's going to be a rebound in output in the second half of this year, which we hope will go into the following year. So just to summarise, by way of conclusion, we do think that there's a sharp contraction this year. The previous slide illustrated that, but we do think there's also a rebound to follow. In terms of valuations, we know that they've risen materially, probably against how the economy is moving at the moment, but a lot of that is down to central bank intervention. Bonds, still expensive. Yield compression, again, unprecedented. To get zero nominal return on developed world bonds is unprecedented. And sentiment has improved, but from extreme lows, extreme bearishness, and the risks we've just talked about: COVID-19, earnings downgrades, US election, and then potentially another oil shock. So without further ado, thank you very much. There's a couple of compliance slides here that you can read at your leisure, but at this point I'll hand over to Nimesh.
Well, actually, Laurence, it's David here. Thank you.
I beg your pardon, David.
Thank you so much for your well-informed and interesting analysis of how the land lies. It's much appreciated. It's triggered a few questions in my mind, and no doubt the audience as well. If you do have a question for Laurence, may I request that you use the chat button, which, as Shamik mentioned, should either be at the bottom of your screens, or you may see 3 dots, which if you click will give you the chat option. If you can then select a private chat with Shamik to start putting questions forward, We will collate these for the Q&A session at the end, but for now, we'll move on to the next part of our presentation from Nimesh Shah. Nimesh is a tax expert and a consummate professional who we have no hesitation working with when we need guidance on tax matters for our clients. Nimesh also regularly appears in the media, commentating on news channels like the BBC and broadsheets like the FT, so I wouldn't be surprised if you thought his name was familiar. We've invited Nimesh today to remind us about the current planning opportunities available to us in order to mitigate inheritance tax liabilities. Most of you have worked hard to accumulate your wealth and no doubt paid numerous taxes in the process. It's therefore not unsurprising that the thought of paying yet further taxes on death is deeply unpopular. Nimesh will run us through the tools available to minimise this burden and in addition comment on potential changes the government may have to make to raise funds to ease the increasing budget deficit. So over to Nimesh.
Thank you, David, and thank you, Shamik, for allowing me to present today. So I just wanted to have the next 10 to 15 minutes on inheritance tax planning. And as David was saying, my session will be just split into 3 areas. If you can move on to the next slide, David. So I'm going to just start with talking about the speculation around IHT. IHT has been around since the 80s and hasn't really changed too much, even some of the small rates and allowances. But more recently, there has been government noise and noise from HMRC on potentially reforming the tax. The second part will be around just some basic planning around IHT, and then finally to talk through some structures which I've seen in more recent times as well. IHT is one of those taxes which is probably one of the most irritating taxes when I speak to my clients and contacts. As David was saying in the introduction, it's something that people build up their wealth during their lifetime and pay income taxes and capital gains taxes and accrue their wealth, and they end up having to pay, or their estate has to end up having to pay yet further tax on their death as well. So it's effectively it's set at a particularly high rate, being 40%, which all of you will know. As I said at the start, there has been plenty of speculation around tax changes in general following the coronavirus pandemic and how the government are going to pay for a number of the support schemes, such as the furlough scheme and the coronavirus business interruption loan scheme. It's probably right to say that the government will borrow quite heavily to fund that, especially whilst debt is relatively cheap. But tax changes shouldn't be ruled out. My own personal view is that I don't think we'll see anything dramatic on IHT, and it's more likely that we'll see changes to income taxes, VAT and national insurance, which are much easier to raise taxes for. However, just cantering through some of the speculation that I've come across around IHT, and as I said, it's a tax that is due for reform because it's not really fit for purpose in the modern age. Now, the government had did ask the Office of Tax Simplification some time ago to review IHT. They published a paper, not necessarily around how to simplify IHT, but they also made some suggestions on reforming it, which was a little bit naughty from the OTS. That's not their role. One of the biggest issues for the government is that IHT raises very little. Alongside capital gains tax, it raises less than 1% of all tax revenue that HMRC brings in. And you compare that to income tax and national insurance, which is well over 50% for the last year. It's a particularly unattractive tax for the government, and there have been calls to abolish it completely. Sajid Javid, prior to his resignation or sacking, if you want to call it that, at a Conservative conference, did say that he'd look to scrap it entirely. Now, some of the ideas that have been talked about, if IHT was to be reformed, is whether IHT would be abolished and simply just have a capital gains tax regime which taxes all transfers of chargeable assets, so not cash. Cash isn't a chargeable asset, but any chargeable asset, whether it's on lifetime or death, would be subject to CGT instead of having IHT. And they may change the rate of CGT as well. The speculation that the 20% rate currently could go up to 28% to align it with CGT that currently applies on residential property. The biggest speculation I always find in and around the time of a budget in particular is whether the 7-year rule, the potentially exempt transfer rule, is going to change. Now, it's an incredibly valuable rule that we have in the UK when you compare it to other countries around the world. Most countries have some kind of gift tax or wealth tax, but the UK has this rule which says that if you give something away and survive 7 years, which you'll all be familiar with, then that value falls out of your estate for IHT purposes completely. And many have commentated in government, the Public Accounts Committee in particular, have been quite vocal to say that IHT therefore is a voluntary tax, and a voluntary tax for the rich, because if you plan ahead and can gift everything away before your death, no matter how big the sum, then you wouldn't end up having to pay, or your estate wouldn't have to pay any IHT on death. But I'll come back to the 7-year rule in a further slide. As I said, there's some speculation around whether the rate may change. 40% is considered particularly penal. When I speak to some of my clients who are looking at moving into the UK, we have a very generous non-dom regime, but they're very, very perturbed by the 40% IHT, and they're very surprised that the rate is set that high. It is one of the highest in the Western world. And there's been speculation more recently that could it go higher? Could it go to 80%? There was an article in the Telegraph about 2 weeks ago. My own view is that's highly unlikely. If the rate is to reduce, and some have suggested a rate of around 10 to 20%, it's probably likely that the potentially exempt transfer rule would be abolished, and you'd have a lifetime gift allowance, very similar to what the US has and what Donald Trump has done recently, whereby someone has a gift allowance, no matter the number of gifts that they make, but over their lifetime and on death, they can gift around $10 million worth of value. And anything above that amount is then subject to a gift tax, or in our case, an IHT. That is something that could come in as a part of simplifying the IHT regime. I have had recent experience where people have speculated that the PET regime could go completely and be replaced with that gift allowance. And so I have seen a number of large gifts being made recently, accelerating gifts that people would have made to their children and grandchildren so they can lock in the current rules. Now, it's highly speculative, but it's something that people have done because they were looking to make that gift anyway. So they're just preempting a potential rule change that could happen. Just finally, something called business property relief, which I'll mention a little bit further on as well. Now, this is an incredibly valuable IHT relief, and it's sometimes referred to as business relief as well. Now, this can relieve the value of assets to up to 100% in relation to IHT. So if you hold an asset that qualifies for business property relief on death, that value is completely relieved from IHT, i.e. you're not charged IHT at all. And because it's been so generous, that some have speculated that it could be limited or restricted in some form, or gone completely as well. The mantra behind it, and I say IHT goes back a number of years, is that the government didn't want to penalise those that had businesses and wanted to pass those businesses down to the next generation, family-owned businesses. And so it was unfair of them to charge IHT on death, and then the business would either have to find the cash, or the family would have to find the cash, which would typically come from the business, which would then stifle possibly growth and limit employment as well. So they've introduced this relief in order to manage that issue. So that's a bit about the speculation around what may change. But what does the current world look like for IHT? So if you can move on to the next slide, David. Thank you. I always say that IHT you can plan with, and the earlier you start planning, the better. And I have a client who's in their late 20s, who sold out of their business, who has said to me that he's very, very worried about him passing away. He's in good health, but he's concerned that his children won't be left with anything. So he's already embarking on a IHT strategy. which he's put in place, which will take him over the next 10 years or so. And I mentioned the time frame because it's one of the planning routes that I suggest that it's something that you can't solve overnight. As I said, we have this 7-year rule, and gifting, if it should come into your IHT strategy, it does take a period of time. You need to chip away at this liability. There is no silver bullet, and it's the simple things that I would always start with. Now, I say at the very start of this slide, spend it all. And some of my clients and contacts do have that belief that if they can just spend everything or give it all away, then on their deathbeds, they have very, very little, or they're below the IHT threshold, the nil rate band, which is currently 325,000, 650,000 for a married couple. And so their estate doesn't have to pay any IHT at all. Now, for larger amounts and those families who want to certainly leave a legacy to their children and grandchildren, that approach may not be so favourable. You could have a very good time in trying to attempt it in a Brewster's Million type scenario. Outside of spending it and gifting it, you start with just putting wills in place as well. And the number of occasions that I do come across that people do not have their wills effectively in place is quite staggering. And we're talking about large amounts of value here. If anything, you want to ensure that your assets do pass to who you want them to, so that there's no disputes on death as well. Sadly, I do see conflict between family members, siblings, and also where there's been more than one marriage and children from different marriages. It can lead to difficulty post-death. And the only people that really win are the professionals like myself and the lawyers, and certainly that's not something that would sit right with most of my clients. So starting with an effective will strategy is the basic first rule. And typically most people will have wills which say that their estate will simply pass to their surviving spouse, and we have a spousal exemption on death, so that transfers between husbands and wives of the same domicile do not attract IHT, and that is to an unlimited amount. What's really valuable as well is that when assets do pass on death, whether it's to your spouse, so completely exempt, or to the next generation, they also benefit from a capital gains tax uplift to market value. So what that means is that if you have an asset that you bought for £10 during your lifetime, but it appreciated in value and now is worth 100 on your death, whether your spouse or your children inherit that asset, they are seen to inherit it at the then market value of 100. And so the gain is washed out completely, which can be an effective way of passing value from the surviving spouse onto the next generation as well, that they can do that CGT free. Which takes me on to lifetime gifting. I've already talked about the 7-year rule. And in most cases, people will have a strategy of making some gifts during their lifetime as well. The 7-year rule is helpful in that after 3 years of making the gift, the effective IHT rate does start to reduce by 8% every year until it reduces to 0 on the expiry of the 7-year clock. So even after 3 years, you're still winning. Also as well, what people forget is that if you have an asset that could appreciate in value, say a share in a company or a property, you could gift that asset at today's value, and today's values could be arguable to be very low because of the current situation. And then any future growth in value is accruing in the children's estate or the grandchildren's estate as well. The value that sticks in your estate for the purposes of the 7-year rule is the value at the point you gift the asset. So future growth can be ring fenced. And as I said, after 3 years, the effective rate of IHT does start to go down. But you do need to be careful when gifting assets. Cash is the easiest asset to gift because it doesn't attract CGT, but many people have property and stocks and shares, assets which are subject to capital gains tax. So where you gift an asset that is subject to capital gains tax, a chargeable asset, you're regarded as disposing of that asset at market value, at the current market value. So you could end up with a capital gains tax charge at 20 or 28% in order to gift that asset. There are some occasions where you can defer that capital gains, but those are very limited. So you do need to watch out for it. And you could end up in a worse situation whereby you end up gifting an asset, crystallizing that CGT in lifetime, and then not survive 3 years, in which case you've ended up paying 40% IHT and the capital gains tax at 20 or 28%. If you are looking at gifting assets, whether it's cash or assets, then it's worth looking at what life insurance options you may have. And you can achieve life insurance over a 7-year term, which is protecting the potential IHT liability should you pass away within that 7-year period as well. And life insurance can also be used on a wider basis as well. So if we can move on to the next slide. So this gives an example of life insurance, and my opening caveat here is that at Blick Rothenberg we don't advise on life insurance policies specifically, but I do know that Shamik and David can talk to you about this if you wanted further assistance. But as part of your overall IHT plan, life insurance should be considered. It may not be appropriate in all circumstances, and it will depend on your specific situation as to what the costs of the life insurance would look like as well. But I talked about a 7-year term, which would cover any gifts that you decide to make or any sizable gifts you decide to make. But it's possible to look at IHT over specific terms as well. And this slide is an illustration of a recent example of a married couple, both very, very young in their 40s, who essentially wanted to cover £5 million of potential IHT, and they wanted to cover the disaster scenario should they pass away within a certain period, leaving their children with a difficult liability to cover in terms of liquidity, because most of their assets were in real estate or in shares, which would then mean the children having to very quickly sell down assets in order to fund the IHT. So part of their driver was to A, have the sleep at night factor, but B, to have the liquidity in their estates on their passing should the worst happen, so that their children could effectively cover the IHT without having to have a fire sale of assets. And as you'll see from the slide, I don't want to go through each of those numbers, but the effective cost when compared to the IHT can be very attractive. Now, I would stress that this was a married couple, both aged 40, so very young, relatively speaking, good health conditions and non-smokers. So they would have achieved very attractive terms, which is what the illustration shows as well. And as I said, Shamik and David can talk to you a bit more about life insurance options if that's something that you're interested in. But my takeaway from this would be it's worth considering. There's no harm in having a quote so that you know what your options are, and then you could decide what you want to do. I briefly touched on as well something called a life insurance policy around whole of life. So where the example shows 10 and 20, 30 and 40-year terms, that's over a specific period. The insurance will cover the possibility that the married couple will pass away in that particular term. What a whole of life says, and it says it's on the clues in the name, is that it covers the IHT liability irrespective of when you may pass away. Now, in theory, the cost of a whole of life may be more expensive, but again, David and Shamik can talk to you about what possible cost would look like. But a component of whole of life and a component of term, possibly as well to look at some insurance around if you're looking at gifting, that could be quite a neat, low risk way of managing part of your IHT liability. Just finishing off on some of the basics, and I'll canter through these as well because I'm just conscious of time as well. So the basics are using the allowances. Everyone gets a nil rate band, whether it's on death or you can use it on your lifetime as well. And the use of trusts is often talked about in the papers and certainly talked about in my arena as well. You can set up trusts during your lifetime to take advantage of the nil rate band, which, as I said before, is 325,000, 650 for a married couple. So a married couple could fund a discretionary trust during their lifetime to the tune of 650,000 without having any upfront inheritance tax charges. If you were to put in value above that amount, then an inheritance tax charge at 20% on your lifetime would crystallize. Now that sounds very unusual as to why someone would have an IHT charge during their lifetime. The reason is that the value of the discretionary trust, provided the married couple are excluded from benefit, is outside of their estate completely from IHT. So on their death, it's not considered, or it's not added up as part of their estate. So everyone would set up a trust just before they pass away, say, put all their assets in, and it doesn't really then form part of their estate. So we have this 20% upfront charge to prevent people from just throwing all of their value into a trust. But you can build up nil rate band discretionary trust during your lifetime. As I said, the sooner you start, the more 7-year nil rate band discretionary trust you could have. So you could have 1.4 million, just under 1.4 million of nil rate band discretionary trust within the space of about 14 or 15 years, if you so wish. I'd just note as well that the nil rate band of 325,000 hasn't increased now for over 10 years. It's long overdue an increase, so it's not even increased for inflation. But we do have something called the residence nil rate band. It's a viciously complicated component, and not everyone will benefit from it. And it also starts tapering away for estates above 2 million. Now, I could talk about that all day because it is so complicated, and I would suggest that you take specific advice from your lawyer and tax advisor if you do want to look at how you may benefit from it. But generally speaking, for a lot of my clients who are well above that 2 million of assets, they won't benefit at all. So it's not really even worth spending too much time on. I've talked a lot about gifts. We do have a valuable exemption in our law, which is something called the normal expenditure out of income exemption. So this is where the 7-year rule doesn't apply. And it's really to account for the fact that parents will fund their children for education, for when they buy them a meal at a restaurant, when they want to give them a present. And you don't then have to account every time that you've given something to your children and you have to record it for 7-year purposes. If it's a regular gift, if it's coming out of your normal income, then it's immediately exempt. It's just really an example of that impracticality of people having to record all the little gifts that they may make over time as well. Any time that you went out for a birthday meal, in theory, is a gift. Now, this exemption could be used quite valuably in conjunction with using trusts or making outright gifts to children if you so wish. Because if you have excess income, so income that you really don't need, so after the lifestyle that you're accustomed to, after all your expenses, if you have excess income, and I stress the word income again, is that you could give away that income and start a pattern of giving away that income either to trusts or to your children or grandchildren outright, and there'd be no 7-year rule applying. And it's important that then that pattern of regularity relative to your income is recorded as well, so that those gifts aren't taken into account if you were to pass away within 7 years. Pensions are helpful for IHT purposes because in very, very broad terms, the value of the pension is outside of your estate for IHT, and it doesn't attract any IHT charges. Pensions do have other tax rules associated with them and other tax charges that can apply, and we could have another whole session on that as well, which we haven't got time today to talk about. But the general rule of thumb is that the pension pot should be the last pot that you access from an IHT perspective, not at least because you'll suffer income tax to draw it out, other than taking the tax-free lump sum out. So you're paying tax during your lifetime on the income that you draw down, and then that income, that cash now in your estate becomes subject to IHT. If you have other sources, it's better to draw down those in your lifetime and leave the pension pot that can pass IHT free down to the next generation. And there are rules on how then your beneficiaries can then access that pension pot and what tax charges that they would achieve as well. But as I said, I would look to take specific advice around your pension because it is a complicated area. Business property relief assets. I talked about this valuable relief that can relieve 100% of the value from IHT. In very broad terms, shares that are listed on the alternative investment market, and you would need to take specific investment advice on this. So again, speaking to David and Shamik about the possibility of creating a portfolio in these types of assets. But if you were to create a portfolio over part of your wealth in AIM shares, then those can be protected for IHT under the BPR rules as well. Quoted shares on the main exchange, things like BP, Vodafone, etc., those wouldn't qualify for BPR. We just have this specific carve out for shares listed on AIM, and you do need to be careful that not all AIM shares will qualify as well. So it's worth looking at that very closely. But as I say, David and Shamik can certainly talk to you about that. EIS I'll come back to because I've got an example of that, but that can also help from a BPR perspective because they are traditionally investments in unquoted trading companies, which would then qualify for business property relief in the main. And the final point I would just mention is that some of you may have different tax statuses. So we do have a regime in the UK for non-domiciled individuals. Now, if you're not domiciled or not become deemed domiciled, which means that you haven't been resident in the UK 15 out of the last 20 years, your overseas assets can be protected from IHT. So it's worth exploring if you are not domiciled in the UK. And for certain domiciles, for example, persons of Indian domicile, they can override that 15-year rule. So even though they may be deemed domiciled for IHT and other taxes, if you are Indian domiciled, there is a very old tax treaty between the UK and India, which allows persons of Indian domicile to allow their overseas estates to be protected from IHT completely using that treaty. It's something that people should take specific advice on. It's very specific to their circumstances as well. I can talk to you about that should anyone have any specific questions. So just finishing off now on some case studies and some final structuring options. This is something that's been widely marketed in certainly my industry for a number of years now, and it's something that's drawn a lot of attention in the press recently, as well as HMRC. So with any structuring, I'd always advise to take specific advice. These solutions aren't always right for everyone, and they can come with costs and administration as well. But they can be also very valuable in terms of your overall tax planning. Now, the reason that family investment companies have become popular is because of the growing differential between personal income tax rates, 45%, and the reducing rate of corporation tax, which is currently 19%. And it was due to go down to 17%, but Boris Johnson decided not to go ahead with that. And people house their investments in one of these companies. And they're nothing more than a simple vanilla UK company. It could be a non-UK company, depending on your specific circumstances, but generally they are UK limited companies, and you house your investments in them and you benefit from a lower rate of corporation tax. There are other direct tax benefits, which I won't go into today because the focus of this discussion is around IHT. But the main IHT benefit, and the reason that this term family investment company has been coined, is because the family can be the shareholders of this vehicle. And so you can transfer assets or cash into this vehicle and allow your children or grandchildren, or a trust for your children or grandchildren, to be shareholders in this company. And the growth in value of those shares can then accrue outside of your estate for IHT. So it's a means of passing value over to the next generation, that you and your spouse or other family members can be the controlling shareholders and the directors of the company, so that the children and grandchildren can't, for want of a better phrase, dip their hand in the till and take money out to go on holiday or go to the pub this weekend. So it's a means of giving future value away, potentially current value if you wanted to gift segments of the loan away as well, but then you also retaining control over how those assets are invested, and also if and when children and grandchildren can benefit. And as I said, these structures aren't for everyone. They should be highly bespoke, And there has been recent press attention with HMRC, recent press attention, also HMRC scrutiny on how these are used. And my suspicion is that there will be some changes in the future around it. So with any structure that you do go into, it's worth bearing in mind how long the shelf life may be. Can we have the next slide, please? So EIS, the Enterprise Investment Scheme, and I touched on this just before as well. So the Enterprise Investment Scheme is a government approved scheme, and it's there to encourage individuals to invest into private limited companies. Now, in theory, these companies are private, so they're not listed on any major exchange. And with private companies, there is naturally investment risk as well. And you should take your own investment advice before going into EIS type companies, because traditionally they are more higher risk investments as well. And I'm sure David and Shamik can talk to you more about that. But this is an example of, this is a real client example that I advised on just over a year ago in relation to a lady who was in her late 80s, who owned a portfolio of shares worth £5 million and some cash. So her potential IHT liability was 2.4 million, broadly 6 million at 40%. She was very worried about her IHT position, and she wanted to really gift the £5 million share portfolio to her children during her lifetime, mainly to avoid difficulties between her sons falling out with each other. So she wanted to control it during lifetime rather than pass on death. Now, it was a very bespoke example, this, and it's not for everyone, but what she did was that she made the gift of the share portfolio as normal. So she gave a gift to her children of £5 million. And for IHT purposes, this was a 7-year gift. But as I said before, after 3 years, the IHT rate reduces by 8%. What she did with her cash was to make an EIS, a significant EIS investment. And it wasn't just in one company, it was across a number of EIS funds. So she spread her £750,000 investment across a number of EIS companies. And what that allowed her to do was to defer the capital gain that was embedded within the share portfolio. So the share portfolio of £5 million crystallised a capital gain on the deemed disposal to her sons of 750,000. She made a corresponding EIS investment of 750,000, and because of the EIS relief rules, you can defer capital gains up to the amount of the EIS investment as well. So she didn't end up having to pay what she would have done otherwise, being £150,000 of CGT. She was also eligible to claim EIS income tax relief. So this is the main relief that's associated with EIS, and I'm sure some of you are familiar with, whereby where you make an EIS investment, you can get 30 pence in the pound back from the government by way of knocking off 30% from your tax bill of the EIS investment made. So a £750,000 EIS investment carries a £225,000 tax credit against your tax bill. Now, just to stress, it can't give you a tax repayment. You do have to have an income tax liability of that amount in order to use that relief. After 2 years, the EIS shares that this lady had invested in were relieved from IHT because of business property relief. The companies that she invested in were all qualifying companies for BPR. Generally, if a company qualifies for EIS, you'd expect it also to qualify for business property relief. Not always, but because the rules of the two regimes are very different, so you need to check the rules. Just because something qualifies for BPR doesn't mean it qualifies for EIS and vice versa. But in this case, she invested in assets that did qualify for BPR. So the £750,000 value became protected from IHT, whereas before it was in cash and subject to IHT as normal. Now, this lady is still very much alive. She's in very good health. But on her death, if she was to pass away still holding the EIS shares would pass freely of any CGT, and any IHT because they are qualified for BPR, as I said. But crucially, those deferred gains that she would have crystallized had she sold the EIS shares do not come back into charge on death. Those gains disappear into the ether on the person's death as well. So when you crunch all the numbers through, and I appreciate it's slightly difficult maths, but for her £750,000 EIS investment, she potentially has saved £2.675 million of tax. That's not for everyone, as I said, and it's really, really important that you do take specific investment advice if you're thinking about building up a portfolio of EIS shares, because traditionally these are investments in private companies, generally smaller companies, and therefore there is, in theory, higher risk with them. But as I said, Shamik and David. The final slide that I wanted to talk about was trusts. I've mentioned trusts occasionally throughout this presentation so far, and it's something that I see mentioned in the press every week, and I'm sure that you hear it as well from your contacts and colleagues and friends. And there is maybe a misconception that you throw everything into a trust and the IHT bill goes away or the tax completely disappears as well. There is a misconception that they are tax avoidance tools completely, and they have had some bad press attention over the years as well. But trusts are actually nothing really to do with tax. It's a very old English legal concept, and the purpose of a trust is to allow someone to give away the assets but still retain control over them. The assets are held in trust. The beneficiary of that trust can't go and access those assets unless the trustees, the person or the persons given responsibility over those assets, allow them to have a distribution as well. So it's a way of giving things away but still retaining control. Now, for tax purposes, there are a number of tax considerations that you need to think about if you are looking at gifting into trust. I've already talked about where you can gift up to the value of your nil rate band into trust without crystallizing that 20% upfront charge. Also, it's possible where you're gifting assets into trust that you can hold over any capital gain. This isn't always available on giving assets to individuals outright, but because of the way the trust rules work, it's possible to make a specific election to not have to pay the upfront CGT charge. So it could be a means of gifting assets into trust, but not crystallizing that CGT charge because the gain is deferred. The gain doesn't go away, it's merely deferred into the trust. So if the trust was to sell the asset, then the CGT would then crystallize. It doesn't always apply, and you do need to check the specific rules if you are to gift assets to trust as well. But that may be a route on giving assets away without having to necessarily worry about the capital gain. As I said before, these trusts can be funded with the nil rate band, or it could be funded through surplus income because of the exemption that we have as well. So more than 650,000 could be transferred into this vehicle without having that upfront 20% charge by using that exemption. I've mentioned BPR assets. Equally, it's possible to gift assets qualifying for this relief into trust without crystallizing that 20% charge as well. The downsides of these trusts are that every 10 years, there is a parking charge in the trust. And possibly when assets leave the trust by way of capital distribution, up to 6%. And this is an IHT charge, and the formula and the calculation is very difficult. But broadly, what this is saying is that on death, the value of the trust generally is not within the person's estate, provided they've been excluded from benefit. Therefore, the tax rules say that if you don't have an IHT charge on your death because you've taken advantage of giving assets to a trust, is that the government want to then charge you 6% every 10 years to account for the fact that you won't pay 40% on your death. And these 6% charges carry on for as long as the value remains within the trust. it will take a huge number of 6% charges to get up to the 40% mark. So it's well over 60 years of someone's lifetime. But even so, it is still a charge, and it's a tax charge that's periodic rather than just on death, which some people may prefer not to have. As I said at the very start of this slide, there is a misconception that you put all your assets in trust and all the taxes go away. A discretionary trust is subject to income taxes at the top rate of 45%. There is a very small allowance, but beyond that, it's 45% income tax, 38.1% for dividends. So it's very heavily taxed for income taxes, and the same for CGT as well. 20% for most assets, 28% for assets for residential property. So right at the top rate with very few allowances as well. Now, people could have a family investment company underneath the trust to protect against those 45% and 28% CGT charges, and that's something I've seen as well. And finishing off on a positive, the trusts can also be effectively used to make tax efficient distributions to children once they're over aged 18 and grandchildren. And the way that this works is that it's creating an income for your children and grandchildren. Everyone in the UK gets a personal allowance other than someone who's non-domiciled claiming the remittance basis, including children and grandchildren. Now, most children and grandchildren don't have any income in their name. So a trust can make an income distribution to the child, and if they don't have any other income, say they're at university, then you're creating an income for them up to the amount of the personal allowance, say, and therefore they don't have any tax to pay. In the bullet point above, I did say that the trust is subject to 45% income tax. So when a distribution is made, it will carry a tax credit of that 45%, so that it's not double taxation. So the child could get a distribution and reclaim that 45% income tax through their own personal tax return as well. And it's a means then for certainly grandparents that they can set up a trust, and it could be an effective way of paying for school fees in the future for grandchildren. And I'm aware that a number of schools do accept payments directly from trusts where you have this arrangement as well. So it's worth thinking about whether it can also be used in conjunction with certain types of school fees or university fee type planning. But as I've said throughout, these are very bespoke arrangements, and it's important that you do take advice on your specific circumstances as well before going into them. That's everything that I wanted to cover today. I appreciate there's a lot that's been covered. Thank you for your time in listening, and I'd be pleased to take any questions in this forum, or if you want to email me or contact me afterwards, you've got my contact details there as well.
Nimesh, thank you very much for that insightful overview of the estate planning opportunities currently available. I'm sure a number of people in the audience will be thinking long and hard about which of these options might be appropriate for their circumstances. And we're of course very happy to pick up the discussion individually in the future. Normally I would have said now, let's open the floor to questions, but I'm acutely aware that we've gone well over the 1 hour time we had allocated. And we do want to have the session interactive and ask questions. So what I'd suggest we do, as we don't want to have this webinar carry on for the next half an hour, please send us your questions by email, and we will put it to Laurence and Nimesh, and we will get back to you with the answers, and hopefully address all the questions that you have. If you would like the slides from the presentation today, please send us an email and we will forward it on to you. It is quite a sizable file, so we do not wish to clog up your inboxes if you don't need it. We've also attempted to record the session, and if that's worked out, then we'll figure out a way to share this with those who could not attend this morning, but also those who may wish to revisit what has been discussed. So all that remains now is for me to thank Laurence and Nimesh for each of their presentations, and to you, our audience, for giving up your time this morning. We hope the session has been thought-provoking, and if you would like to continue the discussion on anything that's been covered today, or if it has triggered thoughts on other matters in your mind that you'd like to talk through, we'll look forward to hearing from you. Thank you.